I'm Charlotte McLeod with investingnews.com, and here today with me is Matt Geiger, managing partner at the MJG Capital Fund. Thank you so much for being here. Great to have you.
Good to be joining you, Charlotte. Thanks for having me on.
Really good to be speaking with you. I've been looking forward to this conversation. And since it is our first time talking, I thought we could start with a little bit of an introduction to you, your background in the resource space, and what you do at the fund.
Sure. So I manage the MJG Capital Fund based out of San Francisco. We are an investment fund focused exclusively on natural resources, but very much skewed to the junior end of the spectrum. So we hold a concentrated portfolio. I think we're at 18 distinct positions at this point in time, with a median market cap of 40 million Canadian. So again, these are much smaller junior focused names in general. By market cap, our largest position is just over $1 billion CAD at the moment, to give you a sense of kind of the niche of the market that we focus on. I'd say roughly 2/3 of our positions are initiated through private placements. So we're quite comfortable financing companies directly so they can answer that next unanswered question, whatever that may be, an economic study, a resource, an upcoming drill program. And maybe 1/3 of our positions are initiated through the open market for stories that have sufficient working capital to go years into the future without raising additional money. In terms of how the portfolio is currently allocated, our largest metal by exposure is copper at around 35% of the portfolio. So a big bet on 5 or 6 copper focused names at the moment. Precious metals are around 35% of the portfolio as well. That includes gold, silver, and the PGMs. We also have quite a large allocation to the ag minerals, which are very much out of favor at the moment. That would include phosphate and potash. And then we have individual bets on some other companies focused on metals such as nickel, rare earth metals, and carbon credits in one instance. So that's kind of a lay of the land. And yeah, very much a focus on people. That's the very first box that needs to be checked. Then look at the asset quality, the company's structure, upcoming catalysts, of course. And when I evaluate new investments, I very much try to focus on stories where there's opportunity to make money, even if metal prices stay flat for the foreseeable future. So we're not betting on $8 copper or $4,000 gold. Obviously, if that occurs over the coming years, that will add a tailwind to each and every one of our investments. But I want stories at the current valuation and with upcoming catalysts where I see the possibility for value creation, even if metal prices stay exactly where they are at the current time.
Okay, I think that gives us a really good look at yourself and what you're doing. And we have a lot of directions we can go in here. I'm going to start you off with a little bit of a broad question just because you're so focused on the juniors. If we look at the juniors as a group, how would you say they're doing? How is the health of the junior segment looking at the moment to you?
Well, I would say for most of the year, it's been very frustrating. And I think if we look back to periods like 2016 or 2020, we had instances where you saw metal prices move, senior miners move, and the juniors move in tandem. And those were very exciting 6 to 9 month periods, but they ended up being more flashes in the pan. So while it has been frustrating, especially on the precious metal front, to see the gold price rally very dramatically, the seniors and the major miners start to participate in that rally over the past 4 to 6 months. I would argue the juniors are only starting to see some love, really in the past 2 weeks. But I do think we turned an inflection point, I would say late September, early October. So at least within the MJG portfolio, and as evidenced by price action on the TSXV, we are finally starting to see some money trickle down into some of these smaller names. So while it has been frustrating for many investors that are junior focused and have junior positions, I would argue the glass half full perspective is that this is how proper cycles are supposed to work. The metal price moves first, then the money moves down into the largest, most liquid producers. And only then do you start to see the trickle effect into the juniors. And so one could argue that the fact that we're seeing it play out in this manner could suggest that this move is going to be more long lasting and drawn out than those, exciting but flash in the pan rallies that we've seen in years past.
I think I personally like that glass half full perspective. And so for the juniors, you mentioned financing, right? And the money trickling down. Is that the biggest challenge for juniors right now, is just having the funds to move forward? Or are there other things that are presenting challenges for them as well?
There's always a whole suite of challenges for juniors, but I would almost always put access to capital at the very top of the list, and I think that remains the case today. I would argue from an investor standpoint that 80% of these juniors aren't investable. So I think it's very important for listeners of this program to be extremely discerning with which teams that they choose to back. And yes, in a rip-roaring bull market, the very worst of the juniors, so the highest quality, will likely rally in tandem. But unless you get your timing perfectly, you're going to be caught out. So I think it's very important to back the teams that have been previously successful, that are focused on a task at hand that they have, exacting experience in, and are also well invested in personally and focused on. You'll see some CEOs that are, CEOs of multiple companies or sitting on 5 different boards as well. And look, it's hard enough to get a junior company to work if you're focused 110% on it. And the more that you divert one's attention from the task at hand, your odds of success drop off pretty precipitously.
Okay, so that's one way that people can start to weed through these many companies. One of the things that I hear sometimes is that there is simply too many juniors out there, right? There's these zombie companies that aren't really doing anything. They're existing out there, though. Do you think there needs to be more regulation to weed them down, or is that really just up to investors to do their own research, do their due diligence to find the good ones?
Yeah, I think that's the nature of the market. I think there will always be too many juniors. And in fact, somewhat paradoxically, in the very worst of markets and the very worst bear markets, that's generally when the collection of the space is highest quality, because you see the Johnny come latelys weeded out and focused on other asset classes, whether that's crypto or a few years ago it was cannabis. So I would say it's only going to get worse from here. And the farther that metal prices rally, the more excitement that returns into the mining space more generally. I would say the quality of the opportunity set will only get worse and worse. But even in the worst of bear markets, you have to assume that 70 to 80% of these companies are uninvestable. And it's incumbent on you as an investor to really have a process to identify the very best of teams. And if you don't have that process in place, then you either shouldn't be playing in the space entirely, or you should rely on folks in your network and relationships that you build to ask other investors that have been around the block a few times which teams are actually doing quality work and which ones are really there, mining for a salary more than mining for metals.
The other point that I wanted to touch on when it comes to exploration, obviously, as you've been explaining, this is a really tough business, but the major miners need these projects to fill up their pipelines. So are we seeing enough support from the majors when it comes to the juniors, and or are major miners doing enough of their own exploration to support their pipelines for the future?
Well, you touched on a good point. And over the longer term, this is a very distinct trend that we've seen in the resource industry. If you go back to the turn of the century, so 25 years ago, you saw the majors putting in roughly 50% of all exploration expenditures globally. So over half of the money being put in the ground to discover new mineral deposits or to drill out existing ones were being spent by the majors. That number's been cut in close to half. So as of now, the majors are relying on the junior players to make that next generation of discoveries, and are happy to pay up once those discoveries have been made and then take those projects forward. So I think that's a trend that's here to stay. I would also say there hasn't been significant amounts of support from the majors coming down into the junior ecosystem. I think as this metal price environment picks up over the course of this decade, we're going to see that increase because the juniors do need help. And, there are many different ways for major mining companies to participate in earlier stage names. It can be through a strategic investment. It can be through an option deal. It can be through a joint venture at the asset level. Or it can be some of the bigger royalty companies coming down and, providing royalty capital for, earlier stage projects. So I think we see all of that pick up, but I don't think we're seeing it at the moment to the degree that we'll need. to satisfy metal demand looking at 5 or 10 years. That actually makes me more bullish. So again, paradoxically, the lack of the support from the seniors, I think, will make this cycle more, drawn out and more dramatic than it would have been otherwise.
Right. It's very interesting kind of how that plays out. And so on that note, we have seen, though, some interesting M&A activity in the resource sector this year. And I'm wondering, if you look back, is there a deal that stands out to you as particularly significant, or perhaps multiple deals? It doesn't have to be between a major and a junior, just what you're seeing there that looks interesting.
Yeah, I mean, I think interesting is an understatement. I would say these past 90 days have been nothing short of insane. And I would say this is one of the strongest, probably the strongest M&A window we've seen in well over a decade. Just go back 90 days, kind of the deal that kicked it all off was BHP and Lundin Mining's joint bid for Filo Mining. That was 4.1 billion Canadian. Following on the heels of that, we had Goldfields making a move for Osisko Mining. That's another 2.1 billion Canadian. That was an all-cash deal. Then we had First Majestic move for Gato Silver. Not too long after that, that was $1.3 billion. More recently, we had Centamin taken over by Anglo Gold. That was a $3.4 billion deal. Then we saw Silvercrest taken over by Core, $2.4 billion. And then the granddaddy of them all was Rio Tinto's move for Arcadium, over $9 billion CAD. So just between those 6 deals, which have all occurred in a 90-day window here, we're talking over $22 billion in total value transacted. And there's been numerous other deals that are of a smaller scale over that same period. So I think this has been a tremendously active window. And I would actually argue there is more to come, because these deals take time to come together. And I think any discussion that was initiated at Beaver Creek, which occurred just over a month ago, a huge deal-making conference, any deal talks that were initiated then are still going to take another 2, 3, 4 months to actually get across the finish line. So I'm anticipating more activity to come. It's a very exciting time to be in the space.
Right. It's very staggering when you list those massive deals out all in a row like that. So more to come. Of what nature do you think the coming M&A might be? Are we going to see more big deals like you've mentioned, something on smaller scale?
Interesting. Well, of the deals just mentioned, those big 6, the majority of them were precious metals. 2/3 of those were precious metal focused. But interestingly, the 2 bigger ones, the Arcadium and the Filo deal, were both energy metal focused, both lithium and copper, respectively. If I had to hazard a guess, which niche of the market we may see some movement next, I would look at the junior royalty space. So these are royalty names that have a sub $1 billion market cap. Examples that come to mind would be Metalla or Vox, Gold Royalties, Elemental, EMX. That's kind of the crop of companies that I'm thinking about. And I think there are talks going on for sure amongst these different parties, and the high likelihood of there being either a no premium merger, kind of a merger of equal between 2 of these parties, or also the outside chance of one of the larger royalty names, the more established names with market caps north of $1 billion, kind of coming downstream and gobbling one of these guys up, because the valuation spreads have widened really over the past 5 or 6 months between the big boys and some of these smaller, more upstart junior royalty names. So the last deal that we saw within the junior royalty space was Deterra taking over Trident Royalty earlier this year. And I really wouldn't be surprised to see another deal in this snack bracket, potentially before the end of 2024 ends.
Do you have any tips on evaluating deals between royalty companies? Because I think people may be accustomed to looking at how mining companies can fit together, but maybe not so much on the royalty side. Sure.
Well, I think consolidation is always good. The royalty space, oscillates between extremely overcrowded and pretty overcrowded. And so as an investor, and we have close to 20% of the fund invested into royalty companies, the less names on the board, the better, from my perspective. So generally, I like to see deal making really across the board. I have different views on the quality of management teams amongst these groups, and kind of think about it on a spectrum from mediocre to excellent. And so ideally, you want to see some of the teams that I would qualify as mediocre being taken out, and then the combined company being managed by the higher quality management team going forward. And I think that's healthy for the space in general. So that's one thing I'd look at. A second would be, asset synergies. Some of these companies, and I won't go into specifics here, but hold royalties over the same assets. In a couple cases, hold royalties over multiple of the same assets. So that makes abundant sense. You're not getting a whole crop of new royalties into the portfolio. In some cases, you're doubling or increasing by 50% an existing interest in a royalty that you already know really well. So I like to see higher quality management team take over, and the more overlap there are between the existing portfolios, also the better.
Okay, so we have this M&A spree going on, and it's likely to continue. Is that playing into your investment strategy? You have all these juniors in the portfolio. Are you wanting to see them taken over? Are you wanting to see them do something else? I'm sure it varies from company to company, but overall, the strategy.
Yeah, that's interesting. I think it manages, or it varies by business model. So we own companies that are prospect generators. We have 30% of the portfolio exposed to prospect generation, which is a business model that's very much out of favor. For those names, it would be great to see a royalty. In some of the cases, the prospect generators have hidden royalty portfolios that the market's not recognizing. So I do think there's the outside chance for some of these smaller royalty companies to come in and either take over the prospect generators outright or buy, one or all of their royalties. But that's not something I'm banking on with those investments. I'm banking on these teams going out, doing good geological work, and hopefully with a partner making that next big mineral discovery. We also own some earlier stage exploration names. I usually try to stay away from single asset explorers that are pre-discovery. But on occasion, if there seems to be an exciting discovery that has been made, we'll jump on board on the back of a major discovery hole. Those cases, you're looking at an acquisition potentially down the line, but that's a bet on drill results, continuing or even improving from the levels that we've seen. I'd say the one niche of the portfolio where I very much am banking on acquisitions are what I'd call the high quality development stage names. So these are projects that have PEAs, pre-feases, or feasibility studies on their projects. They're advancing it through permitting. They're advancing it through social licensing. And I look for projects that make abundant sense at current metal prices. So names with, an NPV using reasonable assumptions, well in excess of the initial CapEx that it takes to build, projects that ideally have a payback of 3 years or less, projects that have, IRRs on an after-tax basis north of 25%, and projects of a scale and with a mine life big enough to matter to larger mining companies. So when I make an investment in these types of companies, which often are in the trough of the Lassonde curve, it's after that exciting speculative phase. Now they're trying to prove to the market that the economics work and that the permitting and the social license is such where this can actually be built in the future. Those are the types of names where I'm ultimately banking on an acquisition.
Okay, really interesting to go into that. And you mentioned prospect generators are out of favor right now. So I'm wondering why you think that is, because I feel like some years ago, they were really put forward as, a model that you should be looking at. It was interesting. So what is happening there?
Yeah, I think two things. First, I would still would 100% argue that it is the most intelligent way to make a new discovery. It's extremely hard to make a new mineral discovery. It's really pulling a diamond out of the rough. But if you can spread your bet over 6 or 7 different projects and bring in larger partners to fund the exploration, yes, if a discovery is made, you're not going to have 100% of the pie, but you really increase your chances of being involved at all in a mineral discovery. And tremendous wealth can be created in the discovery of a new mineral deposit, even if you don't own 100% of said deposit. I'd say the reasoning for why the business model is out of favor is twofold. The first is it just doesn't have the sex appeal of going, for 100% owned project. Like retail speculators and junior punters, they want to swing for the fences. And obviously, if you know you're going to make a mineral discovery, it's better to own 100% of it than 20% of it, or to own a chunky royalty over it. And so there is that allure of focusing on something 100% without a bigger party in there and trying to make that discovery on a 100% basis. And I think that just appeals to the risk and the greed, I would say, of junior punters out there. And then the second variable is something that we discussed earlier. We're not seeing as many of those bigger parties come downstream. And half of the prospect generation business model is to use one's geological expertise to go out and stake promising land packages where a discovery could be made. And then the second half of that is to go attract partners to come in and spend money to advance the project forward. And if you're seeing a reluctance of the bigger parties to move, down into earlier stage mineral exploration, that's, by default going to make it a little bit more difficult to execute the model. However, I think the valuation of these companies has gotten so cheap that it's a very attractive field to be looking. And then again, as discussed, I do think we see the activity pick up in terms of these bigger guys coming down and looking to make that next discovery in conjunction with the junior partner.
Okay, it does. Thank you for going into that. It does make sense how you've laid it out there. So if we look over to commodity, I want to ask how important commodity is to you. So you mentioned you've got a chunk of the portfolio in copper, a chunk over in the precious metals, and then down to the other elements. So I guess that is the question. Commodity, how important is it for you?
Yeah, I think that's a very important question. And I would also say newer investors that are coming into this space, the urge is to go out and find that hot commodity. I'm really excited about lithium and go out and buy 12 different lithium juniors and make a beta bet on the lithium price. I really do not think, unless you have exquisite market timing, that is the way to succeed as an investor in the junior patch. When I evaluate the different factors of a potential new investment, the factor that I look at very last is the metal. So I really do not care what commodity the company's focused on. If I trust the management team, they're well incentivized. If the project looks good at spot metal prices, the company structure is conducive to success. If there's catalysts in the calendar and the company's funded to accomplish those catalysts that can drive significant value, I really try to tune out the metal of focus as much as possible and not get caught up in the FOMO of whatever the hot metal may be month to month. That's very difficult to do, but I truly believe that's the way to have long-term success in this space. Now, of course, I do consider the metal towards the end of the process, and I just want to make sure that we don't already have too much exposure to that metal within the MJG portfolio. And also, if the metal in question is already so hot and looks speculative, then maybe I'll avoid it at that point. But it's really a small variable in my overall decision-making as an investor. You do mention, however, we have a lot of exposure to copper. And so I would phrase that as we have 5 different investments that check all the boxes in terms of people, asset, structure, upcoming catalysts, and of course, price relative to what I think value is, that just happen to be copper exposed. So clearly I'm comfortable with investing in the metal copper, but I'm in these 5 different copper focused investments, not because they're copper focused, because they check all the other boxes and just happen to be focused to copper. So I think that's an important distinction that can be lost on folks that are kind of wide-eyed and new in the junior patch.
Okay, so the commodity kind of down toward the bottom of the list there, but I do want to touch a little bit more on gold. So you mentioned gold at the beginning of the conversation. Gold is on this really intense run this year, making new all-time highs almost every day. It feels like I'm kind of getting afraid to look at the chart. So any thoughts on that? Are we due to consolidate? Do you see it going higher? Is it going to bring in these generalist investors that we've been hearing are at some point going to be allured by the high gold price?
Yeah, well, you're spot on. I mean, this has been a remarkable run. Gold is up over 40% now year to date. And gold, the oldest financial asset, is not supposed to move 40% a year. So this is one for the record books. And I also should note that gold has now outperformed the S&P 500 over a 1-year, 2-year, 3-year time horizon. And if you look back even further, it's actually outperformed the US stock market going back to the turn of the century, which is quite remarkable because the US stock market in its own right has been on a really remarkable run here over the past 17 years or so. So it's been an incredible move for gold. The good news, the optimistic point here is that most of this move has been spurred by central bank buying first, and then participation of institutions and retail investors in the emerging world. I think we're starting to see signs over the past 30 to 60 days that we're seeing a pickup of interest amongst Western financial institutions. And I think that eventually moves to Western retail investors. So I think once Western parties participate in full, that's going to provide that next leg higher. But I really don't think we're seeing it to any serious degree. Just on Friday, as an interesting anecdote, gold hit an all-time high, which is a really big deal, again, for the oldest asset class known to man. And I went on the CNBC, Market Watch, Wall Street Journal, and Bloomberg website homepages. There was not a single article on any of those 4 sites dedicated to gold, with it hitting an all-time high. So that to me, the contrarian in me likes that. With that said, it's already been a sensational move this year. And I would actually like to see that consolidation that you mentioned. I wouldn't mind at all for gold to just hang out at current levels for 3, 6, even 9 months. Like, we've come a long way in a short period of time. Allow the technicals to reset. And then, in 2025 or early 2026, we can see the Western investor world come in mass and provide that next leg higher. So I feel no rush for gold to move any higher from where it currently is. And, given that we have clearly decent gold exposure within the MJG portfolio, but I would like to see some of the excitement we've seen around precious metals trickle into other areas in the metals complex. And I think that's quite possible. Not always, but especially in recent years, you've often seen gold serve as a bellwether for the rest of the metals complex. And then those metals move after a lag. The most recent example was 2020, where you saw gold and precious metal equities really rip from the spring of 2020 into Q4 of 2020. And then 2021 and the first half of 2022 belong to metals other than gold. And so I would like to see something similar play out in this case as well, and give gold and the precious metal equities more generally a chance to consolidate at current levels.
I think that would definitely be nice to see. And okay, so theoretically, we do have new investors coming into the sector at some point. And we've touched on this a little bit earlier in the conversation, but I always think it's an interesting question to ask. Mistakes that you see people make when it comes to investing in the resource sector, especially juniors, key things that you would say to avoid.
Well, first is getting wrapped up in a metal price narrative and just throwing your money at a basket of juniors because you're convinced that, whether it's uranium or lithium or gold or whatever the hot metal of the day is going to continue to perform. I think that's, first and foremost. Secondly, would be de-emphasizing the quality of management team, in exchange for maybe getting excited about the rocks or getting excited about the metal of focus. That's another key mistake one sees. A little more nuance would be, buying a junior on the open market when they don't have sufficient capital in the kitty to accomplish that next unanswered question or 2 unanswered questions. I think if you don't have the ability to participate in private placements, you shouldn't be investing in many juniors, period. Because if you put money into a junior on the open market, but they don't have the ability to do that next drill program or get that next key permit or put out that, PEA study, you're at best going to see your investment stagnate. And then at some point, they're going to come to market, and more sophisticated investors are going to be able to come in, likely at a discount to where you put capital in, and likely with at least a half warrant sweetener to increase their potential upside. And as an investor, that's just not a game that I would want to play. So I think it's very important, if you're buying on the open market, to be sure that the company has enough cash in the bank to knock out at least 1, if not 2 significant share price catalysts where you could see value driven significantly higher before the company next needs to come back to market for capital.
That's really interesting. Maybe just a side question here. I think one thing I hear about sometimes is, there's too many barriers for investors to participate in private placements. Do you feel like that's true, or are they in place for a reason?
Yeah, I'm a bit of a bit libertarian leaning on this front. I think some of these rules and regulations that are in place are well-intentioned, but I know plenty of high net worth investors that are accredited and can participate in these financings that have no idea what they're doing. And I know plenty of folks that don't have, enough capital under management currently, enough of a high enough net worth to qualify as accredited, that are, experts within the junior space. So I think these artificial barriers, while well-intentioned, preclude savvy investors from participating. And I think that's a shame. I think everybody should be able to stand on their own legs as an investor and not be boxed out of deals because of artificial barriers that are put in place by regulators. So well-intentioned, but I would like to see personally the accredited investor stipulation, both in the United States and Canada, done away with entirely. I think that would be a societal good.
Very, very fair points, I think. And just before I let you go, I do want to touch, it's great to talk about precious metals and copper. These are important topics. But you also mentioned the, I think, agricultural side of the fund. So I am curious about that. I've heard about this as an upcoming area that investors should consider looking at. So any small thoughts that you would share there before I let you go?
Sure. Well, it's definitely a niche of the resource market that has been entirely overlooked. I would argue going back to the 2007, 2008, 2009 period, which is the last time we saw a very significant ag mineral boom. And when this narrative gets going, it's intoxicating to investors because at the end of the day, we all have to eat. It's very obvious. And once you see these prices of potash, phosphate, nitrogen on the rise, it's very easy for uninformed investors to kind of jump on that train. And I do believe that every proper commodities bull market, there is a window when the ag minerals really run. We haven't seen that at all yet. We saw a little bit of excitement in the 2022 time period when Russia and Ukraine went to war, and there was concern about supply disruption coming out of Russia, particularly for potash, Belarus as well. That's turned out to be more of a flash in the pan, and prices of the major ag mineral producers all the way down to the juniors have really come off significantly over the past couple of years. And we've gone through a period of close to over a decade of underinvestment and exploring for new deposits, developing existing deposits, and building new mines in this space. So you've got to pick your spots. But I'm quite optimistic on the ag minerals, over the next, we'll say 3 to 5 years. And I'll say that our potash exposure comes through a diversified royalty player. So it's not a pure play potash name. It's actually a name I've written about publicly, so I'm happy to mention. It's Altius Minerals. I would argue that their royalties over the Nutrien and Mosaic mines in Saskatchewan are the core of that company, their single most important asset. And then our phosphate exposure is definitely more speculative, and it's in a North American focused developer of a very advanced phosphate project in Ontario that I do think has the potential to be taken over by a larger party, or maybe make it into production this cycle. So more speculative, much more upside there as well.
Okay, thank you for going into that. I think that's a really interesting place to look at. And I will let you go now unless you had any final thoughts that you would leave investors with.
No, that was very comprehensive. Thanks for having me on, Charlotte. And I think we covered a lot of ground. And I would just I'll end with where I began. Focus on the quality of people first. And if that box is not checked, discard that investment and go look for another one. There's over 3,000 juniors out there. There's plenty of fishes in the sea. And I think the most important aspect of any one of your investments are who the people are at the helm.
Okay, well, very good. Thank you for being here. And once again, I'm Charlotte McLeod with investingnews.com. And this is Matt Geiger with the MJG Capital Fund. Thank you for watching. If you like this video, make sure to hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.